So the next thing we're going to do now is to treat the credit sales. We're going to be fast so that we don't take too much time treating all this. Credit sales. So mark $2,000. We know once more we have two events that took place in this transaction. Two events. The first event is sales, and the second one is Mark getting to hold the business. So you have an entry inside the sales account, and you also have a posting made into Mark's account, and this ledger account will help you to be able to track how much Mark is going to be holding the business at the end of the month or at the end of the year. That's the essence. So let's look at it again. Credit sales. Sales is always an income, is always a revenue, and the rule says income should always be posted on the credit side. So I come here and say, Mark, how much? $2,000. For every credit entry, there must be a corresponding debit entry, and that will land in Mark's account. You have $2,000 from sales. That's how to do your posting, very simple. Alternatively, you can say, who is Mark? Mark is a debtor to the company. Now, Mark is owing the business. To the business, this is a sum of receivable or an amount that the company is due to receive from Mark in the future. So that's an asset. And the rule says, debit your asset is here. This is literally very, very simple. Very simple. Now, let's move on to the next transaction. We've got paid $100 for stationery. Two postings, two things happened. One, we got stationery, and two, we made a payment. Now, I told you already that in the cash account, there are only two things that happen. It's either the business is receiving money into the cash account, or the business is making a payment out of the cash account. So in this case, the business is making a payment out of the cash account. The rule says credit payment. So I have this on the credit side. I say stationery, that gives me $100. This is a credit entry. Then you will now have a corresponding debit entry on the opposite side of the stationery account. So credit here, then come to stationery and say 100 coming from where? From cash. Another way to this posting is to say, what is stationery to the business? Stationery simply means to the business an expense, and the rule says here, PIL. Here must be debited, PIL must be credited. So expenses, assets, and receipts must always go to the debit side. The same principle, without any difference, will apply to insurance. Why? Because in the case of insurance, insurance is an expense just as stationery is an expense. Then we made a payment as we made for stationery. So the same posting is what you're repeating. So I come here, a payment was made for insurance, credit your payment account. You come here and say insurance. How much have you got for insurance sum? I have $200. A credit entry once more. For every credit entry, there must always be a corresponding debit entry. So I find my second leg, which is going to show in the insurance account. So I come here and say insurance. That's coming from where? From cash. Insurance is an expense account. Expense accounts must always be debited forever. Nevermore. Okay. Next, I have paid $400 to bank. This is a very simple transaction to trade. Paid $400 to bank. Let's see. Perhaps that. Okay, don't forget, previously we made a credit purchase from bank. We bought goods from bank, which is $800,000. The liability that we are paying them. So, out of this liability now, we have decided to make a payment of $400. Don't even rack your brain around this thing. Two things happened. One, we made a payment from the cash account to bank, and secondly, now the money that we are going to bank has reduced from $800 to $400. So start with your payment. I told you it is safer for you to always start your post to the first leg from the cash account and just transfer the second leg to the opposite side of the corresponding account. So here a payment was made from the cash account. Once more, your payment is to be on the credit side. So you say payment of how much? $400. Then you put to pay. You have had your first entry here, a credit entry, which must have a corresponding debit entry inside where bank's account. Credit entry, you have the corresponding debit entry. You don't even need to think about that. So I've got $400 coming from cash. Now I'm going to tell you this for those that are learning accounting for the first time. This is one of the things that you really have to quickly get in accounting. You see, all these accounts you're seeing, they are means of communication. They are languages of communication in accounting. I can interpret. If you give me these hundreds of accounts, I'll tell you what the meaning is. I'll tell you the story of a business. Looking at this ledger accounts without having a prior knowledge of what happened in it, I will tell you through the ledger account because these ledger accounts are communicating certain things to me. So, if you get to put figures on the same side in accounting, it means you should add them together. And if you get to put figures on the opposite side, it means the two of them must be subtracted from each other to get a balance. That's what it means. So from there, I proceed to the next transaction. Received $1,000 from Mark. That's the opposite of what happened in case of paid $400 to Ben. Now we received cash. It is a receipt of money to the business, and then the rule says debit your receipts at all times. So I come to the cash account and say, I just received a sum of $1,000. That's coming from what? Mark. This is my first entry, which is a debit entry. Then for this entry, I must have an opposite entry in Mark's account, which is a corresponding credit entry. So you find Mark account, $1,000 coming from where? Coming from cash account. Very simple. Very simple. Next, owner withdrew $200 from a business. This is one of the heavy things that you have to know. You have to know. You have to know. You see, the treatment of this is still coming from the entity concept that I taught of earlier. Entity concept says that always, at all times, it should be that the business is a separate entity from its owners. I don't want to start talking about that now because of time. I have seen a lot of businesses in my time of consulting for people so far that most of the time what even gets to kill the business is the owner's drawings. We call these owner's drawings. The owner will draw money from the business at all times without control. So the business is a different person from the owner. So anytime the owner is taking money from the business, there has to be an account to capture that. So that you can tell at the end of the year, hey, the chairman, sir, this is how much you have withdrawn from your business in total, and this is what is left in your business. So anytime the owner gets to take resources from the business, we call it drawings, or you call it withdrawal. So you're making a withdrawal from your business, it goes to drawings accounts, okay? So now let's see, in this case, the owner withdrew money from the business. That means it was the business that made the payment to the owner. You have to get that right, okay? So the business decided to pay some money to the owner. The owner withdrew money. And now you have to understand that whatever account you are preparing is not for the owner. That's one common mistake that people make in accounting, and they struggle up. You have to look at all the transactions from the angle of the business because you are preparing all these accounts for the business. And that is why you say the books of accounts of AJ Limited for so year. You're not going to say the books of accounts for Mr. Daily for the year. You don't prepare accounts for the owner, but you get to prepare accounts for the business. So let us move on from there. So the business made a payment of $200 to the owner in form of withdrawal. This is a payment. Credit your payment. You say how much? $200. Then on the credit side, here you credit your payment. Now you have the first leg credit, then you know that the second leg is coming to the debit side. That is coming from what? From cash. Very simple. Okay, next, which I believe is the last transaction. Bought vehicle on credit from A Limited. Once more, we call this a credit transaction. You are not making any payment of cash or receiving cash, so just leave your cash account alone. It is not concerned by this transaction. So What are the two things that happened? One, we bought a vehicle, opened a vehicle account. And two, we are now owing A Limited. So you also get to open, do we have A Limited account on the board? We don't have, so you can just try to squeeze it in here. A Limited account. You open A Limited account, which is somebody that we're owing money to. So let us look at it. We bought a vehicle. What do you call a vehicle in a business? The vehicle can offer services to the business. The vehicle can help the business to generate income. The vehicle can help the business to cut its cost and save its economic resources. Then we'll say that this vehicle is an asset to the business. Then go to your rules again. Debit here. Expenses, assets, and receipts. So once more, your asset goes to the debit side. Then I'm too sure. I'm not guessing. You don't guess in accounting and say, okay, oh my God. Debit, receiver, and credit. You don't get a guess. You have to be sure, because in accounting, for every single thing that you do and every single thing that happens in your business, there has to be a reason. So this is an asset. Then you debit it and say, how much do we have? The asset, vehicle. So both vehicle on credit from A Limited. I'm going to assume a figure. Let me just assume $500. Okay. So you debit your vehicle account, coming from where? This is coming from who? Here is coming from A Limited. As it's coming from. Now you have your debit entry in vehicle. What happens next? You are going to have a corresponding credit entry in A Limited account, which is the opposite side. So I come to A Limited and say, vehicle credited $500. Why am I crediting K Limited's account? It's very simple. The business now is owing K Limited. Don't forget, any amount that you owe someone is called a liability. It is a debt. It is called financial obligation, or you might choose to call it payables. So in this case now, A Limited account is a liability account which must always be credited. The very reason why you have this on the credit side. So this way, I'm done with all my journal entries, I'm done with all my ledger accounting entries. So the last thing I have to do at this point will be to create my trial balance at the end of the day and test whether all these postings that I've made in the ledger accounts are absolutely correct. Okay. So I'm going to have my trial balance on this side. Quickly, a trial balance on this side. Now, the trial balance, I told you, is a statement prepared for the purpose of testing the arithmetic accuracy of postings made into the general journal or made into the ledger accounts. We want to test whether the postings have been correct. And we said that the trial balance is not an account, rather it is a statement which has two columns, as always expected in accounting. And when I said it has two columns, it simply means that you must have a debit column and you must also have a credit column. And as a reminder, this is always coming from the practical implication and application of the double entry principle, which says that for every transaction that you have in the business, you have to create two entries. One is going to be on the debit side and the other is going to be on the credit side. So I come here and say, trial balance. Trial balance. You have the credit column in dollars and the debit column in dollars. Then what you're going to be doing is you'll be transferring the balances in each of these accounts to your trial balance. Very easy. Now, I'll start with my cash account. I'm going to start with my cash account. What you do in accounting is you look at the two sides and get what the balance is. Then you start from the side that is higher. The two of them must be the same at the end of the day. So let me do it. 1,000 plus 1,000 plus 1,500. What do I have? I have $3,500. Okay, here. Now the two of them, whatever you have here, must always be what you have here. Okay, so if you total the figures you have here, it's not up to 3,500. So I'm going to put the higher figure. Then the difference between the two will now be the balance of cash in hand. So let's take the difference. 600, 800, 1214. Okay, so the difference now is going to be 2,100. You call this balance carried down. Okay? Okay, I'm going to check this again. 600, 800, 1214. 14, you have 2,000, 2,100. Yeah, that's a balance carried down. So if you have a balance carried down this way, you must also have a balance BD, which is a balance order. You transfer it to the opposite side. 2 entries, don't forget. So your balance BD falls on this side, 2,100. Okay, let's do the same for bank accounts. 800 is higher than 400, so you choose the higher figure. 800, I'm going to be fast about this. 800, so what's the difference you have here? The difference is 400, which is your balance carried down. And for every balance CD, there must always be a balance BD, which is brought down, about $400. Okay? Now we have to do the same thing for Mark's account. Mark gives 2,000 higher figure, 2,000 higher figure. Then your balance carried down is a what? That's the difference. The balance carried down is the difference in the account. You come here and say balance BD $1,000. Okay, we have another account which is okay. We can just leave this because of time. Okay. So we've done our balancing, okay? Then you come to the trial balance and start bringing the balances in. First is cash in hand. What is your balance? The balance for cash in hand is $2,100. Taken. Then you go to the next account. The next account is bank account. Bank. You can see the balance I get from the cash account is from the debit side. So you put it on the debit column. Don't even calculate anything. Just lift your balance from whatever side it is. It's on the debit side here, so lift it from the debit side and put it on the debit column. The same thing for bank accounts. Where is the balance? The balance B, the final balance is on the credit side. So you just lift the balance from here and put it on the credit side, which is $400. Then, so then I have $400. Then next, you have Mark account. Mark's account, the final balance is on the debit side. So you come here and put it on the debit column, 1,000. So 2,1, 400, and 1,000. Then you have drawings. Drawings account. Drawings is on the debit side. Then you bring it to the debit side. Just transfer it to the same side. We're done with that? Then let's go to capital account, which is also equity account. It's on which side? Credit side. Just take it to that same credit side. 1,000. Purchases account. If you have up, you have 500 plus 800. This is going to give you how much? It's going to give you $1,300. $1,300 on which side? The debit side. So you come here and say $1,300 is coming from purchases. $1,300. Then next you have sales. How low? 1,500 plus 2,000. That gives you what? 3,500. Then you have sales. I'm just trying to save time. Okay. Now what you are expected to do here is sum up the figure you have here. You have 1,500, 2,000, 3,500, 3,500. Then your balance carried down here is going to be 3,500. So you can go do that on your own to close all the other accounts. It's still the same thing you're going to have. So I got finally my balance carried down here, 3,500. And for every balance carried down, you must have a corresponding balance brought down. So you have 3,500 on the credit side. So that's what I have at sales, 3,500. Now, the next thing you got is stationery. If you like, you can do the same thing with stationery and close your accounts. It's on the debit side. So I have $100. Taking, I'm taking. Stationery. Next, I got insurance on the debit side, 200. Next, I got vehicle on the debit side. How much? $500 taken. And lastly, I got Hay Limited account, which is on the credit side, $500. So, I've taken care of everything. Okay. So at the end of the day, you now get to total all your debit entries, the debit column, and total all your credit entries, which is your credit column, and ascertain whether it is accurate. So at the end of the day, you must have the same figure. Whatever you have here has to be whatever you have here. That's when you say that these postings you made here are free of any kind of principle-based postings, errors, and all of that. So let's just quickly do the calculation. Okay, let's do the maths. This is 4,000, 5,000, 5,400. You have 5,400 on the credit column. Then on the debit column, you got 2-1, you got 3-1, you got 3-3, and 3-3, 3-6, 4-6. You have 4-7. Press the calculator. You have 4-9, and you have 5,400 on the debit column as well. So 2-1, that gives you 3-1, 3-3, 3-6, 4-6, 4-7, 4-9, and 5,400. You can see what we have in the trial balance now. It's accurately balanced, telling us that the postings that were made into all this ledger accounts of the journal entry are postings that are correct. That is arithmetic accuracy we're talking about. But later, we will be looking at a topic we call correction of errors in suspects accounting. Cases where your accounts can get to balance, but there are still errors in the ledger or general journal. We call that balance in error. And there could be some reasons for that. We'll be looking at that in a separate section where you have errors of original entry, error of commission, error of principal, error of compensation, and error of complete reversal of entries or transposition error. So we will be able to cover all that in a separate lesson. So that will be it for today. Thank you very much. And always remember, we want to take your questions, we want to take your comments. Always remember to take your comments. Okay, drop it down and let us know what are the areas that are giving you problems in accounting. That is why we have this channel. The channel is for you. It's not for me, okay? And I really do love you. Thank you very much.